It is front and center as we count down to tomorrow's rate decision. My next guest, expecting 75 basis points like many others, says the market might actually welcome even more aggressive tightening. Joining me now, Ed Yardeni. He is the president and chief investment strategist at Yardeni Research. Welcome back. It's nice to see you as always.
Thank you, Scott. Thank you.
What got my attention more than anything else is not the call for 75 tomorrow. It's the call for 75 at the next meeting, and that the market can somehow handle that.
Well, I think the markets fully appreciates the fact that the Fed has turned hawkish. And I think we're going to hear more hawkish talk from Fed Chair Powell at the press conference tomorrow. So I don't think it's going to be any surprise that they're going to do 75. I tell you the truth, I wish they would just do more of it faster, just get it over with. The two-year Treasury is at 4%. So the financial markets are already anticipating certainly this 75 basis points up ahead here, but they could easily stomach more given that they've already discounted it. The faster we get to that so-called terminal rate, the better off we'll be in terms of the market. I don't think the economy is going to be completely stressed out into a deep recession. I think we're going through what I call a rolling recession, and I think that continues through the second half of the year.
But you really believe that if they, 75 tomorrow is in, right? I mean, everybody expects that at this point.
Right.
You really think that 75, though, at the next meeting and the stock market, if it hasn't already gone back to that level, won't go back to the June lows?
Oh, no. I think the June lows made the lows, and I think we're in a range between the June lows and the August 16th high. So the June low is 3,666, and the August 16th high was 4305. I think that makes the range for the rest of the year. I think that's where we're going to be. I expect that earnings are just going to be flat, and that the PE multiple is just going to create the volatility that we've seen all along in this marketplace. So it may very well be that the Fed does 75 tomorrow. I will not be surprised if the market rallies on that, closer to the top end of the range, because we're near the bottom of the range. And then I think you're right, the market's going to focus on, okay, now what's next? And if in fact 75 is what's next, the market's going to be torn about whether that's a good thing or a bad thing. Again, I think we want to get this over with. I think the faster they do it and declare that they've got restrictive enough so they can pause, I think the market would welcome that.
And maybe it depends what market you're talking about. I mean, maybe it depends most of all what the bond market does tomorrow, right? I mean, you're the guy. You coined the term bond vigilantes back in the 80s. So
Correct.
You watch it and read it closer than most. Yes. What are you reading from it today?
Well, I think it's very, very important to look at all the markets, how they're interacting. And what I see is that the spread between the 10-year and the two-year has gone negative. Everybody has seen that. But I think we have to understand that what that is in fact implying is that the Fed has gotten into restrictive territory in terms of short-term interest rates. I mean, as we've seen the two-year rate go up, we haven't seen the 10-year go up as fast. So now last I looked, we're about 40 basis points into negative territory. That's the kind of action in the past that's suggested that bonds are actually attractive.
Now, some say the 10 years call him you-know-what on the 2-year. The 10-year, they don't think that the Fed's going to be able to push it to where some think they'll get. We'll see. Ed, I appreciate your insight as always. We'll talk to you again soon. That's Ed Yardeni.